Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ACHR Aviation.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, I really want you to imagine a scenario for a second here.
Okay, let's hear it.
So you step out of your office in, say, downtown Manhattan. You take an elevator up to the roof, and you just board this sleek, fully electric aircraft.
Sounds very sci-fi.
Right. And 10 minutes later, you are touching down at JFK Airport. You completely bypassed, the 2 hours of gridlock traffic down below.
And let me guess, the whole trip costs you a fortune.
Well, that's the thing. It costs about the same as taking Uber Black. Now, for a decade, that scenario has been nothing more than a very expensive, very cool PowerPoint presentation.
Yeah, the classic startup pitch deck.
Exactly. But today, we are doing a deep dive into the exact financial moment where that PowerPoint actually becomes a commercial reality. We're looking at ACHR Aviation.
It really is a critical moment for them. We just got their Q1 2026 earnings, and we're officially watching this technology transition. It's moving from the theoretical R&D lab into actual commercialization and, real revenue generation.
Which is huge.
It's a massive pivot for the entire sector. But before we get into the fundamental numbers and the actual stock itself, I want to quickly share a tool that can help you visualize these kinds of massive market shifts.
Oh, yeah, go ahead.
If you want help reading trading charts more clearly without getting totally overwhelmed by all the noise, you should definitely check out VIP Algos. The link is below in the description.
It's a solid tool.
It really is. VIP Algos is a TradingView indicator suite that essentially cleans up your entire workflow. It gives you these visual buy and sell chart alerts, tools for trend direction, and it even maps out support and resistance zones. Plus, it gives you take profit and stop loss planning areas right there on the screen.
Which takes a lot of the guesswork out of charting.
Exactly. It's incredibly versatile. You can use it across stocks, Forex, crypto, gold, futures, pretty much whatever you're looking at. But, just remember, VIP Algos is strictly an educational chart analysis tool. It is definitely not financial advice.
Right. Very important distinction.
Yeah, it does not place trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so you have to manage your own risk and do your own research. Also, full transparency here, that is an affiliate link.
So we might get a little kickback.
Yeah, we may earn a commission if you use it, but it's at absolutely no extra cost to you.
All right, let's move into the wealth building context. Because when we pull up a company like ACHR Aviation, we had to figure out how this actually, fits into a portfolio.
Yeah, context is everything with these kinds of plays.
Because right off the bat, I got to say, if you are looking for a safe, predictable, dividend-paying utility stock, this is definitely not the room for you.
Oh, not even close. This fits a highly speculative, incredibly high growth profile. It is strictly for the long-term, thesis-driven investor.
So what exactly are they trying to do right now, financially speaking?
Well, what ACHR is doing right now is trying to bridge what the venture capital world calls the valley of death.
The valley of death. Always, always a very reassuring term to hear when you're talking about putting your money into a company.
No, it sounds super dramatic, right?
Yeah.
But it is honestly the most accurate description for hardware and infrastructure startups.
Break that down for us. What is the valley of death in this context?
It's that massive, terrifying gap between spending billions of dollars on capital-intensive research, development, testing, all that upfront stuff, and actually reaching the multi-trillion-dollar total addressable market on the other side.
So you're just bleeding cash.
You are burning cash every single day with very, very little coming in. You're just trying to survive until that commercial switch is finally flipped.
But let me push back on how an investor should view this for a second. Is this just like a quick flip for momentum traders? Because whenever I see a stock that is entirely based on a futuristic promise, like flying cars, it naturally attracts a lot of hot money.
Oh, definitely. You're going to see people jump in and out.
Right. People buy in on a flashy press release on a Tuesday, and then they dump it by Friday. Is that what we're looking at here?
It absolutely attracts short-term traders, and you'll see a ton of volatility because of that. But from a true wealth-building perspective, this requires a completely different mindset.
How so?
Well, imagine someone pitching you the concept of the railroad back in the 1800s.
Okay, I'm picturing it.
You're looking at a company that is buying millions of tons of steel, they're blowing up mountains with dynamite, they're laying wood across the desert, and they are making absolutely $0 doing it.
The cash burn must have been terrifying.
The upfront cost is astronomical. But whoever lays those tracks owns the entire future of transportation. That is exactly what Archer is doing right now. They are laying invisible tracks in the sky.
Invisible tracks in the sky. I like that.
It requires a multi-year thesis, not just a short-term gamble, because you are investing in the creation of a brand new global infrastructure layer.
Okay, well, if they're laying invisible tracks, we need to look at what they're actually paying for the steel. So, Sarah, that gives us the bigger picture. Now, let's look at the fundamentals. Let's dig into the Q1 2026 earnings, because this is where the futuristic promises hit cold, hard accounting.
And numbers.
Yeah, the numbers. What does the actual cash situation look like for them right now?
Well, the big news is they finally have actual revenue on the board.
Okay, how much?
It was small, just $1.6 million.
Oh, 1.6 million.
Yeah, but mathematically, that actually represents a 433% year-over-year jump.
Wow.
This early revenue is primarily being driven by their expanded operations over at Hawthorne Airport in Los Angeles. And interestingly enough, their GAAP EPS loss came in at negative 28 cents.
Which, if I remember correctly, actually beat the consensus estimates.
It did. It beat the estimates.
Okay, but let's be real here for a second. $1.6 million in revenue is practically a rounding error for a publicly traded company.
It's tiny, yes.
But like you said, the percentage growth proves the engine is actually starting to turn over. However, the EPS beat really only tells part of the story. I'm looking at their cash flow statement right now, and they burned about $149 million in operating activities.
Right.
Plus another $32 million in capital expenditures for the quarter. So let's just do the math out loud on that. That is roughly $180 million going out the door, just incinerated, every single quarter.
It's a huge number, true. But you have to weigh that burn rate against what they actually have sitting in the vault.
Which is how much?
They hold roughly $1.8 billion in liquidity. So that's cash, cash equivalents, and short-term investments. In the startup aerospace industry, that is considered a fortress balance sheet.
Wait, $1.8 billion sounds like a massive pile of money. I'll give you that. But in aerospace manufacturing, one bad supply chain bottleneck can just vaporize capital.
Oh, absolutely. It's a very capital-intensive game.
But okay, let's play this out. If they are burning $180 million a quarter, and they have $1.8 billion in the bank, that gives them exactly 10 quarters. That's 2.5 to 3 years of runway before they hit a brick wall and completely run out of money.
Exactly. And honestly, that 3-year runway is the entire fundamental thesis right now.
Explain that.
That runway is why they are structurally de-risked compared to almost all of their peers. A lot of other air taxi startups are just suffocating right now. They are right in the middle of that valley of death we talked about, and they are flat out running out of cash before they can even get their aircraft legally certified to fly.
So Archer's just trying to outlast the paperwork.
Basically. Archer has the cash buffer to actually survive the government's regulatory process.
And that regulatory process is the ultimate bottleneck, isn't it? Let's break that down, because building a really cool prototype in a warehouse means absolutely nothing if it's illegal to fly it over a city.
Right. And this is really Archer's biggest competitive moat. They are actually the first manufacturer in this entire space to clear Phase 3 of the FAA's type certification process for their Midnight aircraft.
Let's explain what that actually means for you listening, because Phase 3 is not just a casual rubber stamp. The FAA uses a notoriously rigorous 4-phase certification process for any new aircraft.
And it takes years.
Years and years. Clearing Phase 3 means the FAA has essentially looked at all their engineering and agreed on the specific testing and certification plans. It means the core design of the aircraft is effectively frozen and approved.
It is a massive, massive barrier to entry. It basically prevents two guys in a garage from just building a giant drone tomorrow and trying to compete with them.
Exactly. So the regulatory moat is deep. But beyond just the civilian side, they are also building a fascinating dual-use defense mode, right?
Yes, they are. Archer has partnered with Endural to develop a hybrid autonomous aircraft.
Now wait, explain why a civilian air taxi company is partnering up with a defense contractor. That seems like an odd pivot.
It's actually a brilliant financial strategy. Military procurement cycles are often much, much faster and significantly better funded than civilian markets.
Oh, okay. So they're going where the money is.
Exactly. By partnering with Endural, who, specializes in autonomous defense systems, Archer can use these highly lucrative government defense contracts to essentially fund their advanced materials research.
And their software development.
Yes, their self-flying software. They get paid by the military to develop this cutting-edge tech, and then they can just seamlessly port that exact same autonomous technology back into their commercial passenger taxis later on.
That is incredibly smart, double dipping on the R&D.
It really is. And furthermore, they are actively building a high-tech AI infrastructure stack. They're backed by NVIDIA, Palantir, and Starlink.
Okay, so that gives us the business picture. They have the cash runway, they have the FAA nodding along, and they have military contracts subsidizing their tech. Now let's move to the catalyst timeline. What is actually going to move the stock price over the next, say, 3 to 24 months?
First up on the timeline, we have their Q2 2026 earnings coming up in August. The market is going to be laser focused on their forward guidance here.
What are we expecting?
Right now, management is actually projecting an adjusted EBITDA loss of $170 million to $200 million as they actively accelerate their certification and defense programs.
You know, it is a weird paradox in the stock market where during this specific phase of a growth company's life, predicting that you are going to lose even more money can actually be seen as a bullish catalyst.
Right. It seems backwards.
It does. But it's bullish, provided that the extra spending is directly speeding up the timeline to that final FAA certification.
Precisely. The market wants them to spend money if it buys them time. Then, looking a bit further out at the second half of 2026, we have a massive, tangible catalyst. We're expecting their initial commercial passenger flights to actually begin under the White House's eVTOL Integration Pilot Program, or the EIPP.
What does that pilot program actually look like in reality? Are people just hailing these things like cabs?
Not quite yet. It's the government's way of testing how these vehicles actually integrate into normal daily city life. We're waiting on official announcements for dedicated flight routes. It'll likely be in Florida, Texas, or New York.
Okay, so designated test zones.
Exactly. But when you have regular people taking actual flights on established routes, it shifts the entire narrative. It goes from speculative tech to an active, working transportation service.
That makes sense. We also have to look at the macro environment here. The Department of Transportation is currently undertaking a $20 billion air traffic control modernization effort. Now, why does that matter for ACHR?
The radar issue.
Yes, because right now, traditional radar systems ping every few seconds. They really struggle to track objects flying very low between city skyscrapers. Our current air traffic control simply cannot handle thousands of low-flying air taxis buzzing around downtown Manhattan.
It would be chaos.
Complete chaos. But when you remember that ACHR is partnered with Palantir and NVIDIA, you realize they are perfectly positioned. They were literally building the AI systems that will allow the government's upgraded airspace to actually track and manage these vehicles safely.
It's all connected. And then we get to the highly speculative catalysts. Management anticipates winning actual phased government awards for that Anduril hybrid aircraft later this year.
Which brings cash right in the door.
Yep. And, of course, the crown jewel, the LA 28 Olympics. ACHR is already positioned as the official air taxi provider for the Los Angeles Games in 2028.
Let me stop you there, though, because the stock market is a forward-looking machine. Is the Olympic catalyst already fully priced in by over-eager investors? I mean, everybody on Wall Street knows the Olympics are happening in LA in 2028. It is not exactly a secret.
No, it's a great question. The event itself is known, yes, but the economics are not.
Ah, the details.
Exactly. We know they will be flying, but we do not know the specific flight volume. We don't know the ticket pricing. We don't know what the revenue sharing structures are going to look like with the city of Los Angeles.
So analysts can't really build a model for it.
Right. None of that is modeled into the current Wall Street projections because the numbers simply haven't been announced yet. So when those concrete financial metrics are finally released, that will be a massive pending inflection point for the valuation.
Catalysts tell us what could change the story. Now let's pivot to the chart. If the catalysts are what could change the narrative, let's see if the market is actually buying it right now. How is the chart holding up?
Historically, it has been a bumpy, brutally beaten down ride.
It's been rough.
Yeah, the stock is down roughly 22% year to date and down nearly 40% over the last 12 months. It has severely tested the patience of early investors.
But price action tells a story. And the structure of that story is actually starting to shift, isn't it?
It is. The momentum is visibly shifting. The stock recently broke its long-term downtrend. It is up over 11.5% over the past month and up over 5% in just the last 7 days.
Nice little rally.
Yeah, and technical analysts are starting to note that these bullish long-term hammers are forming on the chart.
Okay, for anyone who doesn't just stare at charts all day, let's explain what a hammer pattern physically represents in the market.
Yeah, it's a very specific shape.
Right, so a hammer usually forms when a stock drops significantly during a trading period, let's say a day or a week.
Because sellers are trying to push it down.
Exactly, they're trying to force a new low.
Mhm.
But then, heavy buying volume aggressively steps in and pushes the price right back up to near where it opened. So visually, it leaves a long tail on the bottom and a small block on top. It looks exactly like a hammer.
Hence the name.
Right. It basically shows that sellers tried to force that low, but buyers firmly rejected that price and took control back.
Exactly. It signals a potential macro trend reversal. And what's really fascinating here is that this specific buying volume spiked right after the FAA Phase 3 news was confirmed.
And, this is exactly why traders might use those clean workflow tools we talked about earlier, like VIP Algos, to spot these hammer formations automatically. Because finding those rejections manually across hundreds of charts is super tedious.
Yeah.
But seeing the footprint of buyers stepping in is crucial to understanding the trend.
It saves so much time.
So the chart gives us price structure. But what does market sentiment look like behind the scenes? Like, who is actually doing all this buying?
Sentiment is definitely shifting from cautiously optimistic to distinctly bullish. We're seeing a real change in the narrative from the big players. For example, analysts on Seeking Alpha have recently issued a rating upgrade with a new price target of $8 to $10.
Wow, that is a significant premium to where it has been trading. But you know what really caught my eye? It isn't the analysts. It's the institutional accumulation. Where is the really big money flowing right now?
The biggest signal out there right now is Cathie Wood's ARK Invest.
Interesting.
They have been quietly selling off legacy semiconductor holdings like AMD and TSMC, and they're using that capital to load up heavily on flying taxis.
That's a huge pivot.
It is. They are specifically absorbing Archer's available float. They are literally putting Archer right alongside their high-conviction, massive-scale names like Tesla and NVIDIA.
Okay, let's translate what absorbing the float means in physical reality. I want you to think of ARK Invest like a giant vacuum cleaner right now.
Oh, I like that visual.
Yeah, they're taking shares off the open market and just locking them away in their vault. That means there are fewer available shares left out there for everyone else to buy and sell.
Supply and demand.
Exactly. When the supply of available shares shrinks like that, any good news can make the price explode upwards simply because buyers have to bid higher to find anyone who's actually willing to sell. But I have to raise a skeptical eyebrow here for a second.
Uh-oh. Here it comes.
Retail investors blindly following ARK Invest has been a very, very dangerous game over the last few years. Innovation funds can tolerate massive multi-year drawdowns that a normal person simply cannot stomach.
That is a very valid caution. You should absolutely never copy trade a fund blindly. But the key thing to note here is that it's not just ARK. The average brokerage recommendation across all of Wall Street is currently a solid buy.
So it's a consensus.
Yes, this isn't just one rogue innovation fund taking a crazy bet. It shows a broad institutional awakening to the very real progress Archer is making with the FAA.
That sentiment picture is useful. But no deep dive is complete without looking at what breaks the thesis. We still need to talk about the risks. Let's start with the absolute elephant in the room, execution risk.
Right. Because building two perfect prototypes in a controlled lab environment is relatively easy.
Well, easier than mass production.
Exactly. Scaling up a manufacturing line to build hundreds or thousands of them perfectly, with zero-fail aerospace-grade safety standards, that is brutally hard. Remember, they are burning hundreds of millions annually.
Every single year.
Right. So if they hit a supply chain bottleneck, say they can't source a specific titanium component, or maybe a battery casing is delayed, which is incredibly common in new hardware manufacturing, production completely stops.
But the cash burn doesn't.
Exactly. The cash burn doesn't stop. If that happens, that $1.8 billion cushion vanishes. And if that cash vanishes before they are actually profitable, it leads to massive shareholder dilution.
Meaning they have to print more shares?
The company will have to issue millions of new shares just to raise survival money, which instantly crushes the value of the shares you currently hold.
And then there's the valuation disconnect, and I really, really need to hammer this home for you. We are looking at a $4.6 billion market cap for a company that generated $1.6 million in quarterly revenue.
It's steep.
That is an extreme venture capital style premium being applied in the public markets. At a $4.6 billion valuation, you are not buying the company as it exists today. You are paying for the assumption that they will entirely conquer the market in 2028. Perfection is already priced in.
There's no room for error.
None. If there's a 6-month delay in the FAA timeline or a political hiccup with those defense contracts, the market will reprice the time value of this stock violently. Buying at this capitalization requires flawless, absolute clockwork execution for management.
I completely acknowledge that risk. It is undoubtedly priced for a very, very optimistic future. But I will counter that by noting the 40% drop over the last year means a lot of the absolute wildest froth has already been shaved off the top.
That's true, it was much higher.
The valuation is high, but the total addressable market for replacing urban gridlock with low-altitude airspace is measured in the trillions of dollars. If they succeed, $4.6 billion will look like an absolute bargain in hindsight.
So with everything out on the table, we've got the cash runway, the FAA moat, the heavy risks, and the LA28 timeline. What is the final verdict?
Based on all the current data we've looked at, the final bullish score comes in at a 7 out of 10.
Which makes the stance here speculative bullish. This is a textbook, high-risk, high-reward setup.
It is. And regarding the timeline, this requires a very strong stomach and a multi-year hold. We are talking a 2 to 4 year minimum horizon here.
You really have to wait it out.
You do. You need that time to capture the full economic transition from these early EIPP test flights all the way to scaled revenue-generating operations at the LA28 Olympics.
As for who this setup is actually for, I'd say this is an excellent watchlist addition for highly risk-tolerant investors who are actively looking for an early entry point into a potential trillion-dollar infrastructure shift.
Right.
However, if you are an income investor, or if your portfolio relies on conservative, predictable cash flows just to survive, you should absolutely avoid this stock for now. It is far too volatile and early stage for a retirement account.
Yeah, definitely not for the faint of heart.
And as always, a clear reminder that this discussion is strictly educational and not financial advice. We are not telling you to buy, sell, or hold anything. You must do your own research before making any investment decisions.
Always do your own research.
Also, if you want a cleaner way to visualize the exact kind of momentum shifts and hammer patterns we talked about today, check out VIP Algos. The link is below in the description.
It's a great tool.
It is. It's a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, and TPSL planning areas. It is designed to help make charts much easier to scan, but again, it is only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Before we go, just think about this. If we truly are on the verge of turning the sky into the next global highway, who holds the real power? Is it the companies building the physical flying cars, or is it the artificial intelligence software systems that will have to choreograph millions of flights a day without a single crash? Something to keep in mind as this industry finally takes off.